You wake up every morning believing that earning more money is the answer. Work harder, get the promotion, start the side hustle, save a little more. It sounds logical, but the reality is far stranger. The biggest difference between people who struggle financially and those who build wealth isn't always how much they earn. It's how much life charges them for being broke. Imagine walking into two stores. Both sell the exact same pair of shoes. One customer pays $50. The other pays $100. They walk out wearing identical shoes, but one paid twice as much. It sounds unfair, yet versions of this happen every single day, often without anyone noticing. Have you ever wondered why the people with the least money often end up paying the most? Being broke isn't just a temporary shortage of cash. It's a condition that changes the way every financial decision unfolds. When money is scarce, you lose options.
Think about a simple household appliance. Your refrigerator suddenly stops working. If you have savings, replacing it is an inconvenience. You compare prices, wait for a sale, and pay in full. The problem ends there. But if your bank account is nearly empty, the same refrigerator becomes a financial crisis. You may need financing with high interest, rent-to-own payments, or a credit card balance that lingers for years. A single appliance that originally cost a few $100s can ultimately cost twice as much. The refrigerator didn't become more expensive. Your lack of financial flexibility did. This pattern repeats everywhere. Cheap products often wear out faster. Shoes with thin soles fall apart after a few months. Low-quality tools break when you need them most. Budget appliances consume more electricity and require frequent repairs. Buying the cheapest option feels like saving money today, but over time, it becomes one of the most expensive strategies possible. Why? Because you're forced to buy the same thing again and again. Economists sometimes describe this as the poverty premium. It's the invisible surcharge paid by people who have the fewest resources. Unlike ordinary expenses, this premium rarely appears on a receipt. Instead, it hides inside interest payments, overdraft fees, emergency purchases, expensive insurance, late penalties, and lost opportunities. Consider transportation. A reliable car may seem expensive up front, but constant breakdowns on an old vehicle create repair bills, missed work days, towing fees, and unexpected stress. If you can't afford preventative maintenance, small issues grow into catastrophic ones. A simple oil change skipped today can eventually become an engine replacement worth thousands. Saving money in the short term often creates larger costs later. The same principle affects your health. Preventative care usually costs far less than emergency treatment. Healthy groceries are often more expensive than highly processed alternatives. Gym memberships require spare income. Time for exercise requires flexible schedules. Medical checkups require insurance or cash. When these resources aren't available, health problems quietly accumulate until they become expensive emergencies. Suddenly, financial hardship and physical health become deeply connected. Time itself begins working differently. Wealth buys time. Poverty consumes it. Imagine spending hours riding multiple buses because owning a reliable vehicle isn't possible. Imagine comparing prices across 5 different grocery stores to save a few dollars. Imagine waiting in long lines for government assistance, searching endlessly for discounts, or working multiple jobs with unpredictable schedules. Every hour spent solving today's financial emergency is an hour unavailable for education, career growth, family, or rest. This creates something psychologists call scarcity thinking. When your brain constantly worries about immediate survival, it naturally focuses on urgent problems instead of long-term planning. That's not laziness, it's how human cognition evolved. Thousands of years ago, immediate survival mattered far more than distant rewards. Your ancestors didn't need retirement accounts. They needed food before sunset. Today, however, that same mental wiring can become a disadvantage. When every paycheck disappears almost immediately, planning 5 years ahead feels almost impossible. The future shrinks because today's problems demand all of your attention. And that's exactly where the cycle begins.
The cycle usually starts with a single shortage. Not a dramatic collapse, not a catastrophic mistake, just a lack of margin. Maybe your paycheck arrives a few days later than expected. Maybe your car needs repairs. Maybe an unexpected medical bill appears. For someone with savings, these events are inconveniences. For someone living paycheck to paycheck, they can trigger a chain reaction. A late bill becomes a penalty fee. A penalty fee creates an overdraft. The overdraft reduces next month's budget. The reduced budget forces reliance on credit. The credit creates interest. The interest reduces future income. One problem becomes 5. What's remarkable is how quickly this process accelerates. Financial systems are often designed to reward stability and punish instability. Banks offer their lowest interest rates to people who need them the least. Insurance companies provide better premiums to lower-risk customers. Investment opportunities become available to people who already possess capital. The more resources you have, the easier it becomes to acquire additional resources. This idea has existed for centuries. In the Gospel of Matthew, there is a passage often summarized as, "To those who have, more will be given." Economists later borrowed this concept and called it the Matthew effect. Small advantages compound. Small disadvantages compound too.
Imagine 2 people starting at age 25. The first person has a small emergency fund. Nothing extraordinary, just enough to handle unexpected expenses. The second person has no savings at all. Both experience the exact same $1,000 emergency. The first person pays the expense immediately and continues moving forward. The second person borrows the money on a credit card carrying high interest. Months later, that original emergency is still generating costs. Years later, the financial consequences may remain. The emergency wasn't different. The starting position was. This is one reason wealth often appears invisible from the outside. People see investment gains, growing savings accounts, and appreciating assets. They assume wealth comes entirely from earning more. But many wealthy individuals benefit from something less obvious. They avoid expensive mistakes because they have the financial cushion needed to avoid them. Think about housing. A family with strong finances can move closer to employment opportunities, safer neighborhoods, better schools, and reliable infrastructure. A family struggling financially may have fewer choices. Long commutes increase transportation expenses. Older buildings require more maintenance. Neighborhood conditions affect educational outcomes and career opportunities. The initial housing decision quietly influences dozens of future outcomes.
This doesn't mean every wealthy person succeeds because of advantages, or every struggling person fails because of circumstances. Reality is more complicated than that. Individual effort matters. Decisions matter. Discipline matters. But it is equally true that financial position changes the range of available decisions. 2 people can work equally hard and receive very different outcomes because one has access to opportunities the other never sees. Opportunity itself has a price tag. Consider investing. Many people understand that investing early can generate enormous long-term gains, yet millions never begin. Why? Because investing requires surplus money. You cannot invest what you need for rent. You cannot buy assets with money already committed to survival. A person who consistently invests even small amounts benefits from compound growth. A person trapped in recurring emergencies often misses those opportunities entirely. Compound interest is sometimes described as the 8th wonder of the world. But compound interest works in both directions. Assets compound, debt compounds too.
This is where financial reality becomes especially counterintuitive. Most people focus on income because income is visible. You know how much you earn. You see it arrive in your bank account. But wealth is often determined by what happens after income arrives. 2 individuals earning identical salaries can experience completely different financial futures.
One spends every dollar servicing debt, replacing low-quality purchases, paying fees, and reacting to emergencies. The other uses savings to avoid those costs. Over time, the gap widens. Not because one person is dramatically smarter, not because one person works dramatically harder, because one person benefits from positive compounding while the other suffers from negative compounding. Every financial decision creates momentum. A good decision rarely changes your life overnight. Neither does a bad one. The power comes from repetition. A single dollar saved seems insignificant. One unnecessary fee feels harmless. One impulse purchase appears trivial. Yet financial outcomes are built from thousands of tiny events accumulating over years. This is why financial stress feels so exhausting. You're not only managing today's expenses, you're constantly negotiating with future consequences.
Every choice carries weight. Every delay carries weight. Every emergency carries weight. And the longer scarcity continues, the heavier those weights become. Psychologists have discovered something fascinating about chronic financial stress. When people experience ongoing scarcity, cognitive performance can temporarily decline. Mental bandwidth becomes consumed by immediate concerns. Future planning becomes harder. Concentration becomes harder. Decision-making becomes harder. In other words, financial stress doesn't just affect your wallet, it affects your thinking. Imagine trying to solve a complex puzzle while an alarm continuously rings beside your head. Eventually, your attention shifts toward the alarm. Scarcity functions similarly. The constant pressure of immediate needs crowds out long-term thinking. This creates a cruel paradox. The people who would benefit most from long-term planning often have the least mental space available to do it. And that's exactly why escaping the cycle requires more than simply earning more money. It requires creating something far more valuable: margin.
Margin is what separates a temporary setback from a lasting financial crisis. It is the distance between your income and your expenses. It is the emergency fund that keeps a broken appliance from becoming years of debt. It is the free evening that allows you to learn a valuable skill instead of taking another shift just to stay afloat. It is the ability to say, "I can wait," instead of being forced to say, "I have no choice." Ironically, building margin doesn't always begin with making more money. It begins with protecting the money you already have. Every unnecessary fee avoided is money earned. Every high-interest debt eliminated is a guaranteed return on your investment. Every emergency prevented is wealth preserved. Think about the habits that quietly reduce financial friction. Maintaining your car before something breaks. Replacing worn shoes before they damage your feet. Cooking meals before hunger pushes you toward expensive convenience food. Paying bills automatically before late fees appear. These actions rarely feel exciting. They don't create dramatic success stories, but they slowly remove the hidden taxes that scarcity imposes. This is one reason wealthy people often seem lucky. From the outside, it looks like life simply goes their way. Investments grow, opportunities appear, unexpected problems seem manageable. But much of what looks like luck is actually the absence of preventable financial emergencies. Stability creates room for better decisions, and better decisions create even more stability.
This is the quiet power of positive compounding. Imagine two snowballs rolling down the same hill. One begins slightly larger than the other. At first, the difference is almost impossible to notice. But with every rotation, the larger snowball gathers more snow than the smaller one. Eventually, the gap becomes enormous. Money often behaves the same way. A small emergency fund grows into financial confidence. Financial confidence leads to calmer decisions. Calmer decisions reduce costly mistakes. Fewer costly mistakes create more savings. More savings create greater opportunities. The cycle feeds itself. The encouraging news is that negative cycles work in reverse as well. Every step toward stability weakens the forces pulling you backward. Paying off one high-interest loan reduces future interest payments. Building your first $1,000 in savings reduces dependence on credit. Learning basic investing allows your money to begin working alongside you instead of remaining idle. Improving one professional skill increases future earning potential. None of these changes transform your finances overnight, but they don't need to, because wealth is rarely built through dramatic moments. It is usually built through boring consistency.
This idea often disappoints people because it lacks excitement. There is no secret investment known only to insiders, no magical budgeting technique, no guaranteed shortcut to financial freedom. Instead, there are thousands of ordinary decisions repeated over decades. Spend a little less than you earn. Avoid expensive debt whenever possible. Buy quality when it genuinely lowers long-term costs. Protect yourself against emergencies before chasing luxury. Allow investments enough time to compound. These principles have survived generations because they reflect something deeper than changing markets. They reflect how compounding shapes almost every part of life. The same principle applies beyond money. Knowledge compounds, skills compound, relationships compound, health compounds. The person who reads 20 pages every day rarely notices a difference after 1 week. After 10 years, the difference is extraordinary. The person who exercises 3 times a week may not see dramatic results after a month. After 20 years, those small sessions become a completely different quality of life. Financial habits follow exactly the same pattern. Small actions repeated consistently become extraordinary outcomes. This also explains why comparing yourself to others can be misleading. You rarely see the years of invisible compounding behind visible success. You see someone's house. You don't see the emergency fund that protected them 20 times before they bought it. You see someone's investment portfolio. You don't see the countless weekends they chose delayed gratification over immediate consumption. You see the result, not the repetition. Perhaps the most important lesson is that being broke is expensive because scarcity removes freedom. It forces short-term decisions that create long-term costs. It narrows your options until every unexpected event feels overwhelming. The goal isn't simply to become rich. The goal is to become resilient. Resilience means a broken tire doesn't become a missed paycheck. A medical bill doesn't become years of interest. A temporary setback doesn't become a permanent condition. Money, at its best, isn't just about buying things. It's about buying options. It's about buying time. It's about buying peace of mind. And those are often the most valuable assets anyone can own. So the next time you hear someone say that being poor only means having less money, remember that the reality is far stranger. The hidden cost of being broke isn't measured only by what's missing from your bank account. It's measured by the opportunities you never get to take, the choices you never get to make, and the premiums you quietly pay every single day. Because in the end, the biggest difference between people who struggle financially and those who build wealth isn't always how much they earn. It's how much life charges them for being broke.